Right now, we have Dylan Enright, founding partner of WeFunder, which is a San Francisco-based company. It's a crowdfunding service that connects startups to investors. We have Karen Kahn, CEO of iFund Women, which is a crowdfunding platform for women-run startups and small businesses. And we have Chuck Pettit, who is a partner at Republic, who, like Karen, is also based in New York City, which is another equity crowdfunding platform, but has a little twist that we'll talk about. And it allows investors to invest as little as $10 in a privately held startup. So I'm going to start with Karen. You know, we were just talking backstage 10 years ago or thereabouts, you know, Kickstarter came out and crowdfunding, this topic that we're all here to discuss, was all the rage. I'm just kind of curious sort of like what lessons you took from Kickstarter and like how you've applied them to sort of what you're trying to do at iFund Women.
Yeah, we took a lot of lessons from Kickstarter. In fact, we did our own Kickstarter campaign to fund iFund Women. And what we learned about crowdfunding, and regardless if you're doing equity crowdfunding or rewards-based crowdfunding, which is what iFund Women does, it is really a marketing and sales exercise for your company. If you are good at marketing and sales, you will be great at crowdfunding. Because basically what you're doing is you're going out and you are selling your product, your services, or your mission or your vision to people that want to invest in you and your company. So with rewards-based crowdfunding, it's cash. With equity-based crowdfunding, like what Republic does, it's equity. So yeah, I mean, I think it's, you know, Kickstarter was the first about 10 years ago, then Indiegogo came on, and then crowdfunding like wasn't that in vogue, frankly. And then, you know, the Jobs Act happened, and here we are, and it's a huge, huge business. And what we're doing is we're empowering the first generation of entrepreneurs right out of the gate, the early stages, to fund their businesses through cash.
How many projects or how many companies have been funded on the platform so far?
Yeah, so we've got a pretty high success rate because we're small and we're new. We're just turning 2 on November 2nd. And our market is, we're focused on, there are 1,800 new businesses being started by women every single day in the United States alone. That's about 650,000 a year on top of the 11 million existing women-owned firms in the United States. This is our market. We are a solution for them to raise very early stage capital for their businesses, for their proof of concepts, to fund a pivot, because otherwise your options are max out your credit cards or go into debt or chase an equity round that you're never going to get. So our market is really, really big. We've got thousands of campaigns on iFund Women and raising millions of dollars. Cool.
So, Dylan, you're kind of like the old man of the group, so to speak, as the founder of the oldest company. You know, you guys launched when? 2012?
It started with a lobbying effort in 2012.
2012. So, you know, that was when the Jobs Act happened. You know, why don't you I'd love to just hear a little bit about kind of like the evolution, but also like why did it take so long for this equity crowdfunding conversation to really start in earnest?
I think it's like crowdfunding is a mechanism by which we fund startups, but what was illegal for 80 years since the Great Depression was this idea that people who weren't super rich could sort of allocate their money as they saw fit. The federal government said, if you don't make you don't have $1 million in the bank or make $200,000 a year, we're not going to allow you to invest in private companies because it's too risky and you don't know what you're doing. So changing very entrenched laws and stigmas took a little while. It started with making a bunch of noise in Boston because we wanted to invest in our friends, and that was illegal. We sort of thought that was BS. And eventually ended up in the Rose Garden watching Obama sign it into the Jobs Act. And naive as we were as kids, we thought that the president signs a law, it takes effect almost the next day. And that is true in some cases. In this case, it gets handed down the street to the SEC and took several more years to iron out about 800 pages of detail that are still incomplete and imperfect and on the floor of the Senate for revision in a couple of weeks. To sort of make this legal just about 2 years ago.
Right, but you're doing deals now. I mean, like how much money has been raised on the platform to date?
We've raised about $70 million for about 225 companies.
And those are all equity deals, right?
They're about 80% equity deals,
okay.
20% debt deals.
Got it. Okay.
But they're all forms of securities,
right?
So to speak.
Okay, Chuck, you guys are doing equity crowdfunding as well, right?
Correct.
Why don't you talk about the crypto side of this,
Sure.
which Republic spun out of AngelList, which is kind of an interesting sort of version of this, but for the accredited side of investors. And then you guys launched this product that allows people to sort of legally buy or legally invest in companies or in tokens, I guess. Why don't you just give people a sense of how that works and what that is?
That's correct. So Dylan at WeFunder, they started with the Title II license, and then Title III is the one that he talked about that came out 4 years after Title II was released. Title III allows ourselves and our issuers to raise capital from anyone in the world 18 or older, regardless of their wealth, and they don't. So basically, they don't need to be accredited, and up comes the token, the crypto world about 1.5 years, 2 years ago, and a lot of non-accredited investors were being left in the dust. They weren't allowed to participate in these investment opportunities. So with our team, we have 6 licensed securities attorneys on our team. We came up with what we think, and we've had it reviewed by, but not formally, a compliant and legal way for non-accrediteds to participate in ICOs. So these things that you see on TV or reading the news, people are raising $200–300 million, that kind of thing, and people are making a ton of money. That was really only available to accredited investors. And most of the time, it wasn't even available to US investors. So we came up with what we call a token DPA. It's a debt payable by asset. And that allows the non-accrediteds or accrediteds to be a lender, essentially, to the company who is developing a token. That entity that's being given this money or borrowing that money has one focus, that is to pay back the investor with tokens once they're released. With investors always on our mind, we also put in safety features where if they were unable to deliver on the token, whether it be for securities laws reasons or regulatory, or they just failed, our investors get anywhere from 50 cents to 85 cents back on the dollar, at a future point if they're unable to deliver on it. So that money actually just sits in escrow while these guys are actually developing their token.
Huh, interesting. I mean, because I think most people think like, oh, well, the whole point of these ICOs is that anyone can buy into them, and like there's no, it's the Wild West. I keep hearing that.
It is. We've had, north of 2,000 applications for our crypto product. We've only moved forward on 4.
Oh, wow.
There's a finite market out there of quality companies. So we really try hard to find those and then build a relationship, get them comfortable with crowdfunding, because there is a regulatory process. A lot of companies don't like to deal with that. So we built a team to make that easier for them to come in and do it.
Karen, you mentioned raising, starting a company basically with a Kickstarter campaign. You've raised outside capital, right, from more conventional institutional investors.
Yep.
How come iFund Women does not do equity? I mean, was that a conscious choice?
It was.
Yeah.
It was. So only 1% of companies, period, I don't care if you're a man or a woman, only 1% of companies, period, will raise venture capital. That's it. So there's a whole world out there beyond this conference room, beyond this live stream, of companies that are never going to be able to raise VC and need to start up. They need a funding source. So we very deliberately are playing in that space where we're giving early stage ideas, early stage founders an opportunity to prove demand for their product or service before they invest in supply. And by supply, I mean inventory. By supply, I mean spending years of your life chasing an equity round. So, there's a whole world out there of entrepreneurs that need funding, and there are literally no sources, especially for women, frankly. So we deliberately didn't go into the equity crowdfunding space. There's also lots of great companies already doing that. There weren't lots of, there are a few big rewards-based crowdfunding platforms. Kickstarter, definitely a little bit more male-dominated. 94% of the highest-grossing Kickstarters are by male creators in gaming, tech, and film. And for a female-run SaaS company, you don't even get into Kickstarter, so there's no place for you to go. So we built our platform specifically for female entrepreneurs across any sector, topic agnostic. In fact, B2B and business services rules the day on iFund Women. They raise more than the consumer products people.
Wow. So those are like pre-sales, or what actually are the rewards? Because I think with businesses being crowdfunded, you think of sort of a restaurant maybe pre-selling, you know, a loyalty card that gives you free coffee or something. Like what's a B2B company giving, you know, as a reward?
So crowdfunding is when you're selling your products and services to people that want to buy them.
Right.
So services. When we talk to a B2B company, they have there's two sets of customers. Let me back up. For a crowdfunding campaign. Yeah. There are your customers or your prospective customers that you're selling your product or service to, and then there's your FFFs, your friends, your family, your followers, people that just love you and that want to invest, right? So we spend a ton of time on the marketing strategy and the network mapping strategy with our entrepreneurs to determine who those two sets of customers are for their campaign and how we're going to market to them. So the rewards could be anything from, you know, your service to, you know, selling things to whoever's in your market. So we also say, like, make the men feel welcome. Men are allowed on iFund Women. We have male crowdfunders. It's not, you know, we do not gender discriminate. We have multi-gender co-founder teams that are performing awesome on the platform. And then we look at the network of the entrepreneur to say, like, how many men do you have in your network? Let's have a dude reward. Like, make the dudes feel welcome. So it's just about getting creative. It's really not that hard.
Yeah. Do you guys, you know, Chuck, Dylan, do you accept what Karen's saying, that, you know, most companies are not going to be funded with equity? I mean, do you think, I guess what I'm asking is, do you think that the amount of company, the percentage could change as, you know, as services like yours become more popular, as it becomes easier to raise equity capital?
I do. I mean, the number is actually 0.6% of companies get venture-backed funding, and 18% of startups get some sort of community debt. That leaves about 81% of startups or small businesses bootstrapping without funding. And if we have to, I think we all have to believe that there are like are there only this many companies worth investing in? Is Y Combinator only finding the best 100 companies and everybody else isn't worth investing in? Are the investors on Sand Hill Road and in New York City investing in the best companies? Meanwhile, only 2% of venture capital goes to women, only 1% goes to African Americans. Is the rest of the country and all these other demographics not innovating? I don't think so. I think it's just that they don't happen to look like me, maybe, or they don't live in San Francisco or New York or Boston, where about 78% of venture capital goes. The other 47 states fight for 22% of VC. The 19 states in the, quote, heartland fight for 5% of venture capital. Meanwhile, there's 8 of the top 25 research universities in those states. I think it's just a matter of exposure, not being in a room like this, perhaps, not knowing the right people, not looking the right way, and maybe not even having the confidence to say, I can start my own business, right? Or I can raise the money, I can go and do this thing. I don't have to leave it in the research lab. You know, you emulate people who have done it before you, and if those around you haven't done it, well, then you're not going to go to Sand Hill Road and raise your hand. So I think crowdfunding and all these platforms offer sort of exposure and opportunity for a wider variety of people who are innovating. They just don't know the right people or know how to make the pitch or know how to sort of take the leap and quit their job and take the risk.
Chuck, are you seeing that already? I mean, the idea that people from sort of maybe underrepresented like communities or regions or
taking advantage of that?
Yeah, I mean, is that actually happening or is it, especially in the equity space? I'm curious, like in your world.
So of the roughly 70 companies that have raised in Republic, 45% of those have at least one female founder, 25% of those have at least one minority founder. We're working with founders from Anchorage, Alaska to Orlando, Florida. You know, the 0.6% of funding going to venture capital going to startups but 78% of that goes to companies out of New York, San Francisco, and Boston. But we consciously think about it every day and try to reach out and help individuals who are in places in the country that don't have resources, that don't have access. And we use words like access and democratization. That's actually what we do. We're really bringing that together, and I think that shows in our stats. I think with the 39 companies that we have onboarding today, plus the 15 that are live, that those numbers will not actually go down. I'm actually pretty sure they'll go up. So it's a great chance for founders around the country, for sure.
So okay, so we're talking about this this idea that, and I think it's core to the idea of crowdfunding, that like it opens businesses up to different communities and people who are not necessarily in the room where, you know, the like country, you know, they're not in the country club with all the like accredited investors in their town or whatever. That said, Karen, you kind of hinted at this, but like I sometimes think, and as an outsider, that crowdfunding is a little bit overhyped in this area, because you do have people basically raising from their own networks. They're not necessarily, it's not a, or I don't know, but talk about this a little bit. Like, like to what extent are people actually able to raise, to sort of find people who they wouldn't otherwise find, rather than just, you know, just sort of using these technology platforms essentially like as ways to like aggregate investors. Like, you know, I just raised money for a marathon I'm doing. I basically sent an email to, you know, 50 of my friends, like they're the ones who invested, nobody else.
Right.
Super convenient, but not necessarily like a game changer. I'm kind of curious what you're seeing, kind of what you're doing to open that up.
Yeah, that's a great question. So when you're raising money for your startup, it's different than raising money for a marathon. So you are essentially getting your marketing and sales act together, okay? So that means really figuring out how you're gonna reach your customer. And that's how we position crowdfunding. Don't think about this as like, I need to go and raise $100,000 or I'm not gonna be able to make it. It's how are you bringing your product and service to market? And so in terms of getting the randoms, we have seen some tactics work. So remarketing is really the one ad-driven tactic that works. So for those who don't know, remarketing is when you do Facebook, Google, Instagram ads, and you're targeting people that are already in your network, that have already set, they're in your CRM, they're in your email database, they like you, they're following you, and they know you. And we also know that humans need 5 to 7 exposures to a brand before they take action, especially people that aren't your besties, but they're in their kind of peripheral network or friends of friends. And so we really recommend doing retargeting ads, and this is not, we don't get paid by retargeting companies.
That's
Facebook isn't paying me for this ad, which
so is Facebook, Instagram, the main
yeah,
platforms?
but it works. But it's basically the idea is that you are advertising to people that know you. Strangers, it's very rare where you're going to get a total random stranger that are going to support your campaign, especially for a B2B company, especially for women. You might get them on Kickstarter if you're like the speaker cooler. But outside of the speaker cooler, it's hard to get randoms. But if you're advertising, if you're marketing, if you have your PR game on point, if you do all those things, you absolutely can draw in a new audience.
Can I was interject real quick?
Yeah.
So to me, these are totally necessary to run a successful campaign.
Yeah.
They're catalysts, they're momentum builders. But I think one stereotype that the investment crowdfunding space has is that investors are not always sophisticated. What I've found over the last 2.5 years is that the vast majority of investors, whether they're putting in $10 or they're putting in $100,000, wants a return on investment. And it's really, basically no different than if you're allocating to your 401k and you get the, your weekly or biweekly paycheck, and 5% goes to the 401k, and then it gets broken down to 20 different mutual funds, and there's like $15 going to one mutual fund or whatever it may be. They want a return on investment, just like that individual does when their paycheck is being allocated to the retirement fund. So that's super important to think about. So yeah, you can do advertising all day long and get a lot of people to support it. Maybe they'll just buy the product, which also is a byproduct in investment crowdfunding, which is great for companies. But ultimately, the majority of people want a return on investment.
Right.
I'm curious how you guys measure return and show that to investors. I know it's early, 2 years in.
Yeah, 2 years in. So we will provide, and we also expect the company to provide updates on a quarterly basis. If they did a recent raise, we're not going to sit there and say, look at this paper gain you've made. If the individual investor wants to put that together, they can. We're really waiting for actual exits to provide, actual figures.
That'll take a long time, right?
Sure.
What about you guys?
I mean, it's hard. Startup investing is hard, especially in a building like this. I mean, the public markets change by the second or less.
Right.
There's a constant feedback loop and sugar high for consumers on their investment. Robinhood is successful for many of those reasons.
Yeah.
And to build a consumer product, as much as we're attracting huge investors writing 6-figure checks, those investors understand this is an 8-10 year game. Some of the smaller investors, they don't. And I think that's one of the biggest hurdles, is talking about returns, talking about waiting, the value of investing, the potential high return in the future. I mean, paper gains while on paper are an important feedback for investors and an important signal for a company. That's why they talk about Series A, Series B. When it's cash in the bank, it's also a signal for hiring. So we have an IRR calculator, which is an internal rate of return, which is basically your return based on follow-on investment from institutional investors. That investors can see the value of their portfolio and their debt instruments and sort of get a rough sense of how they're doing. Because if they have to wait 8 years, it's really hard to keep coming back.
Chuck and Dylan, you've seen equity, basically fundraising people doing the same kinds of things that Karen's talking about, advertising on Facebook, doing the kind of like traditional, I mean, it seems like they're potentially, it gets potentially complicated with securities rules about solicitations and stuff, but like what are people doing to actually market their, like I want to raise money, I want to raise a couple $100,000 for a startup idea, I use one of your platforms. What's the like best practice for like how to market that?
Well, it starts with a good pitch. Too often founders in traditional settings, and especially online, fail to recognize how important that moment is.
Yeah.
And explaining your business, being straightforward about it, and sort of short and sweet. Brevity is the soul of wit, and I think founders often fail to realize that 10 pages of typed words will not get investors' attention, especially online. But then talking about getting a crowd, it starts with your users. Starts with our user base, and I expect theirs. About 51% of our overall investments come from WeFunder users instead of the company's users. And then a lot of successful crowdfunding campaigns do advertise, but it comes at a cost, right? Every dollar you spend to advertise for fundraising is effectively diluting you as an owner, right? You're spending for investment. That's not really how it should work.
Right.
And now it's
a little different than if you're doing a campaign like a normal rewards-based campaign where you're reaching consumers. So it's like a double, you're getting like a double bump with the marketing.
And so we struggle with that, right? We want these campaigns to be as successful as possible, raise as much money as possible. That's how we make money. But to tell a company to spend 25 cents on the dollar to raise capital is, we just think wrong, right? I mean, we tell people the number is 10 cents on the dollar. If you have to go north of that, you're really just not ready for this. Or you should take the money that you raise and make progress and then do this again or raise from sort of other outside investors. I'm curious how you two think about it.
I don't disagree with that 10 cents on the dollar in terms of marketing to raise. Yeah, I mean, for us, it's different. We have Facebook pixel tracking, GA pixel tracking. We are very like data and analytics driven because we know that these brands are just starting out. Nobody knows about them. They've got to get out there. They have to be doing social. They have to be doing PR. They've got to really, their pitch is numero uno. We help them make their videos. We have a video production studio here in the city. We can make videos from all over the world. And that's like one of the things that we see as the biggest barrier to entry for founders coming on board with crowdfunding. So whether it's they're not confident getting on camera, they're not confident giving their pitch, they are going on way too long. We have a limit. It's 2.5 minutes. It's what's your problem? What's the solution? Who are you? What's your domain expertise? And make the ask and goodbye. And we make them, we're like drill sergeants, and we make them do it. Has to be under 2.5 minutes because the attention span of people is honestly 15 to 30 seconds. And so you have to deliver a pitch succinctly, have rewards that people in your network want to buy, regardless of what your company is, sell people things that they want to buy. That's what crowdfunding is about. And so we really train them on that. And it's marketing is a huge part of it. So it's a bit different than when you're going out and raising an equity round for your company, for sure. Yeah.
So speaking of selling people things that they want to buy, or I'm going to twist it slightly, things they need, Chuck, I just want to challenge you a little bit, and Dylan as well. From a point of view of an investor, like me as a guy with like 2 kids and a mortgage, it seems like sort of a bad idea, just generally, to invest in speculative, securities on the internet. Just not even because not on any ground, not because I'm saying the companies are bad or anything, but because like what I read and what sort of the sober-minded best practice of investing is, you not only don't want to buy like speculative securities offered on the internet, you want to buy like index funds. You don't want to buy securities of any kind. And I'm kind of curious, like, what do you accept that? Do you think that actually that's maybe like, I don't know, that misses something, or like what?
No, I think it misses a few things. I mean, the way I look at it is, only invest what you can. If you do make an investment in a startup, forget about it for the next 5 to 7 years. And the third thing is, and it's a reality, expect to lose all your money.
Got it.
If you're a believer in modern portfolio theory, I think a lot of people here have equity debt. They have other derivative options, futures, whatever it may be. There is a place for that in your portfolio. And if you put it at the right percentage and you expect that you want that level of risk, it can blend out. It can work for you in your favor. So I think that's the way to think about it.
I don't think dissimilarly. A small, maybe 10% of a portfolio, you should be willing to lose it all. I mean, the results in startups, unlike public markets, unlike real estate, are pretty binary. You're either going to do really well or really bad, which makes it kind of fun.
Right.
But it's not just about investing and waiting, right? The best startup investors, myself, when I invest, I enjoy the ride. I enjoy helping the startup.
Yeah.
That's like, these companies are so infantile that really good advice and support can go a long way to ensuring your investment is much more successful. And the best startup investors I know in the Valley who have made money, way more money than almost anyone in this building, have done it by nurturing the startups they are excited about. I mean, Peter Thiel is the prototypical example of somebody who invested in Facebook when he was a kid in college and was set for life. And he didn't invest and step back. He invested, he took a board seat, he ensured the company was successful. I think where crowdfunding fails right now, in a big way, is connecting investors with founders in a meaningful way, because it's not just about the money. Right? There's a lot of money in a lot of places. It's about the social capital that comes with the right check, and that's why the best founders still go to Sand Hill Road and not to crowdfunding. Although I do say with exception, we have had some great companies on WeFunder, is because they get the sort of advice and support that is unique to that place, and that is unique to San Francisco, and what we're trying to figure out for the rest of the country. If this industry is really going to be successful, if you want to be successful as a startup investor, think about investments that you're passionate about, where you think you can lend a hand, and not only will it be a better investment, it might just be a little bit of fun.
Yeah, that's really interesting. I mean, I think, and one takeaway for me as we sort of start to wrap up here is just, it does seem like there's kind of a continuum, despite the fact that you have on one hand equity crowdfunding, on the other hand you have this rewards-based thing. It seems like there's actually quite a lot of similarities, because as we think about the why someone would do this, I mean, you didn't sort of mention that, or actually you guys both started to get at it, you might do it for the same reason you'd back your local coffee shop or something, just because it feels good or whatever.
Yeah.
Karen, what do you think the crowdfunding platforms can do better, or where's we're starting to hit at ways in which there's still work to be done. I'm curious where you think the the opportunities are for improvement to help bring more people into the space.
Well, we're doing it, and I don't know if I'm going to give you our secret sauce, on this stage with our competitors here.
Give it away.
But I can tell you that the entrepreneurs that participate in iFund Women enjoy a high level of coaching and mentorship, kind of like what you were saying, which is it's not just about the money. It's about the connections you make. It's about learning from people that have come before you and have done it. It's about collaboration. We have co-founder dating that's happening on our private Slack network, where all these women are solopreneurs. And we've got our super STEMmy ladies who are antisocial, and we've got the sales and marketing ladies and the PR ladies that they're pairing up to become co-founders. So there's just a lot of networking and collaboration and help with each, we have a graphic designer that's helping someone build their website. That kind of stuff and the community elements are equally, and I would argue, more important than the funding that you get out of iFund Women. So I think that's really where the industry needs to go. To your point of it's more, when you're going out and raising equity round, it's more than just the money. It's who's the investor. Are they going to be really helping you drive your business forward? Are they going to be connecting you? It's really the same with rewards-based crowdfunding as well.
Right. Chuck, final thoughts. Where are the opportunities? What can you guys?
Well, on the mass adoption front, I think it can come from basically two places. One is media, part of the reason why we're here today, and the other is from companies like Airbnb adopting it. Dylan's probably going after them too, because they mentioned they want the SEC to allow them to be able to sell shares to their homeowners, which is not legal today because they're not accredited. Most aren't. But they could do it through a Republic or a WeFunder campaign, and then millions and millions upon millions of people would know more about crowdfunding, and they'd probably adopt it quicker. So events like that, plus I think media, are the ways that the mass mass markets adopt it.